Is this mid-cap mania that has gripped the street, or is it a genuine valuation dip that is attracting buyers? Is it greed that has overcome fear, or is it just still very good valuations? All these questions to two people who look at mid-caps very closely. Pankaj Tibrewal of Kotak Mutual Fund and Gautam Sinha Roy of MOTILAL OSWAL AMC. Good morning, gentlemen. Thank you very much for joining us. It's a 12% jump in the small cap index from February 19th. That's the day this index appears to have bottomed for the moment. And it's, I think, a 10%, 9.8% to be precise, mid-cap index move from February 19th. That's quite a move. Gautam, would you call it mania, or do you think it is very attractive valuations?
So in markets, I believe, Lata, the answer always lies somewhere in between. So it's neither mania, neither extremely cheap valuations. It's just that, you know, after a very long, prolonged correction, there were opportunities in the mid and small cap space, and intelligent investors are coming back and picking up those opportunities. And I also get a sense, and this is based on some metrics that I track internally, proprietary metrics, that smart money, domestic smart money is coming back into markets, and that might have to do with the prospects of election results. Remember, this money had started going out exactly 1 year back, around after the budget of last year. Some of that is starting to creep back into markets, and people are taking on risk. So there's a risk on mode in markets today, and also with the fact that there were many attractive stocks lying out there waiting to be picked. So people are picking them up.
Okay, well, that is good to hear. Pankaj Tibrewal of Kotak Mutual Fund is also here with us. Pankaj, you know, you do manage a fund called the Kotak Emerging Equity Fund, and if you go through the returns, the last 12 months have been quite disappointing for a lot of the stocks that you guys had picked up, whether it's names like Ramco Cement, PI Industries, Supreme Industries, etc. Of course, in a bear market, that's what happens. Mid-caps see a larger fall than large caps. But what do you do at this point? Do you churn out of these names, or do you continue to keep the faith in some of these spaces that you've invested in?
Good morning. I think from a longer term perspective, if you look at, we believe that you need to hold on to long term compounders over a slightly longer period of time. Most of the businesses which try to own are good capital allocators. They generate decent cash flows. Barring 12 months, if you look at the longer history of these companies, they have compounded at a much higher rate than most of the large cap companies, and by far they may be leaders in each of the sectors they operate in. So the way we work in is that in the last 12 to 13 months, we saw there was a huge divergence of performance between Nifty and mid and small caps, and they reached at historical extremes. History suggests that post such kind of divergences, normally small cap and mid caps tend to outperform over the next 12 to 18 months. I think the last few days rally is more of the normalization of that part, where mid cap and small caps had become attractive on valuation. Having said that, we believe that this year is not going to be the same wave which we saw in 2017. It's more going to be stock pickers market, and some of the names which you mentioned are actually at a higher levels than what 6 or 12 months back their stock prices were. Dynamics are going to play a very important role. Earnings growth is going to play a very important role. We are not banging on earnings or PE expansion as was the case in 2017. So I think this will be a year of stock pickers, and there will be a separation of men versus boys in each of the sectors which we will witness going forward.
So Pankaj, just to pick out one point, what happened around February 19th, 20th when they bottomed, you think it's largely election related?
You may give an excuse of election related, you may say some other reasons on valuation, but the fact remains that this start of the year, start of the year 2019 has... you okay?
No, what I'm asking you, Pankaj, is that you were making a point that during, in a post-election phase, small caps and mid-caps tend to do better?
No, I'm not making that point. I'm just saying the point that the divergence in the last 13 months between large caps and mid caps, or as represented by Nifty and mid and small cap, had reached historical extremes. And history suggests that such divergences don't last for too long, and the 12 to 18 months post such divergences, mid and small caps tend to outperform. It's just a coincidence that this is just an election year, and this is happening just before the elections or maybe post elections.
Okay. Gautam, hi, good morning. One of the star funds in your portfolio, you know, the Focus 35 fund that launched with a lot of fanfare, delivered great returns to investors, has not done very well over the last couple of years. I guess it's also because in your top holdings, you have a large exposure to some of these consumption-based sectors, whether it's autos, whether it's NBFCs that have exposure to autos, Maruti, Eicher, you know, Bajaj Finance, etc. What do you do now? Because this is a cyclical slowdown that some of these pockets are going through. Do you stick with them or do you churn out?
Yeah. So Sonia, the portfolio got hit, if I look at the attribution, largely from the oil marketing companies and to some extent from the auto companies. Now I believe from a valuation perspective, both these set of companies or sectors have really bottomed out. There were uncertainties on the regulatory front, or at least perceptions of uncertainty on the regulatory front. For oil marketing companies, refining cycle was weak. So I can understand that, but the stocks are really cheap today, trading close to their book values. And I think from here, both marketing margin and refining margin for these companies, whatever be the global GRMs or Singapore GRMs be, the GRMs for these companies, especially in the IMO world, look quite healthy going forward. And the election-related perceived risk is also coming to an end. So they look good from that perspective. Auto companies, the OEMs are trading cheap, but yeah, the growth has slowed down. That is concerning, no denying that. But I don't think that means that it's an end of a story or anything like that. These are cyclical businesses. You know, autos are cyclical businesses, so they go through cyclical ups and downs in terms of their growth trajectory. And we are seeing a very unprecedented and unexpected slowdown in growth, especially since the festive season of last year, 2018. That was brought in by price hikes that they had to take because of insurance cost or some other changes that they brought in because of some problems in a particular state, Kerala, general slowdown in financing post the NBFC crisis. So these are all transient problems, and we believe that over a period of time these will correct themselves. We also take a lot of cognizance of the fact that neither passenger vehicles nor two-wheelers have really seen a huge bumper cycle, in the sense that we have not seen multiple years of double-digit growth, industry growth in either of these spaces in the last 7-8 years. So that essentially tells me that there has to be, if you believe that India's GDP is growing at 10-12% nominal, then there has to be a build-up of latent demand which has happened in these sectors, right? Because end of the day, over the long term, the demand for these categories are closely tied to nominal GDP growth. So I do believe that there is a latent demand existing in the system, and over a period of time it will play out. The difficult part is to predict when it plays out. One of the ways we predict is from the macro part, and I think macro is turning positive, be it crude prices, be it interest rates, inflation. So that's my limited point.
Okay. I'm going to take the cue from that. Actually, we are running out of time. So if I can get briefer answers. Pankaj, is there a rural theme? Because a lot of money has been transferred, whether it's farm loan waiver or farm income scheme.
Yes, in certain pockets, definitely. But the data which is coming out of rural sector is quite mixed. So if you look at the first 9 months of tractor sales, very strong. Normally tractor goes for either infra or rural activities. If you look at some of the commentary coming out of staple companies on the consumer side, very strong commentary saying that rural is picking up. But when you look at from an agro perspective or some of the other bank related data, we are not getting that positivity. So I think it's a mixed bag. We need to approach rural sector from a stock specific perspective. Riding a complete rural wave may not be the right way to approach in the portfolio.
Okay, Gautam, actually what themes would you play now? You spoke about some macros turning.
I think the macro turning positive, interest rate cycle turning in our favor, inflation being benign, crude prices being in a range. These are major themes. These are very growth positive for the country. So that is something that I'll watch out for. I'll also be excited about the fact that this budget has doled out, let's say, around 500 rupees per month for poor farmer families, 12 crore of them in rural India, which should be positive for growth in bottom of the pyramid FMCG consumption. So these are the two delta changes that I am very positive about of late in India.
Pankaj, one word, which sector would you bet on? Sectors.
Capital goods and cement.
Okay. I'm sorry, gentlemen. This is the most absorbing conversation, but we have to call it a day. Thank you very much for joining us.
All right. Well, on that note, it's a wrap on Bazaar. The markets have actually come off a lot from the highs. So all of this action will be taken forward on our next show, Chartbusters. Stay with us.